The world is going through changes. Changes happening at a speed that we have never seen before. This is leading to disruption, chaos, panic, fear, hysteria, and a turbulent economy and marketplace. How do you protect your wealth in a turbulent world? How do you invest for cash flow in alternative assets to escape the rat race in times of uncertainty? How do you decentralize yourself, your family, your community, your business, and your investments to become sovereign and escape the matrix? If you are looking for strategies, tactics, and techniques to escape the rat race and matrix, you are in the right place. My name is MC Lobsher, and this is Cashflow Ninja. This is Cashflow Ninja. I'm MC Lobsher. Thank you so much for joining me for another show and spending your most valuable resource, your time, once again with me. Everything Cashflow Ninja is at cashflowninja.com. The one way that I can help you right now is the weekly newsletter that I put out sharing the best alternative wealth strategies and alternative asset investments. You can subscribe to the Wealth Dojo, which is our weekly newsletter, by going to cashflowninja.com/subscribe. Cashflowninja.com/subscribe. You'll be able to download all of our books. There's links in that newsletter to it. Access all of our podcasts, access all of our reports, and more. I've got a fantastic show for you today. I'm joined by Matt Sands, and we're going to talk about mineral rights and royalties. So before we jump into that, Matt, great to see you.
Thanks, MC. Thanks for having me on. Looking forward to this.
So for our listeners and our viewers that's not familiar with you and what you do, can you please share a little bit about your background and journey?
Sure. So I have been in the oil and gas industry for my entire career. That's going on about 25 years now. I started out working for a large oil and gas operator, so doing different engineering and management roles. And then in 2015, I went off on my own and started a company to invest in mineral rights and royalties and also provide consulting services for mineral and royalty owners and other investors. And so that's sort of what I've done since then. I also have a podcast, which is the Mineral Rights Podcast, and we produce shows weekly. And it's all things mineral rights and royalties, really tailored around the oil and gas side of things, though.
Yeah, it's a fascinating asset class and definitely a fascinating niche. So for our listeners and viewers, this is the first time that you're hearing about mineral rights and royalties. What are they? How do they work? And what makes them an attractive asset class and niche to invest in?
So, starting with oil and gas interests in general, there are multiple ways to invest in that space. The mineral rights and royalty side of things is a real property interest. So it's an interesting way to get direct exposure to oil and gas without having some of the additional risks of having to go out and drill the well and some of those other things. So it's actually transferred by deed. So there are different parts of the mineral estate that are, you get ownership and perpetuity. And usually there's some states that have unique laws you need to be aware of, but in general, it's a like buying a rental property or other types of investment properties. You get that conveyed to you via deed. There are, it's a passive investment. Generally, you're not in control of what happens with those minerals. When you buy the mineral rights, unless you have millions of dollars of capital and want to go and drill the well yourself, you're going to wait and then sign what's called an oil and gas lease with an oil and gas company that will bring in and spend the capital to come and drill the well. And then if they're successful, you get paid royalties as long as that well is producing oil and gas. So it's a really nice way to get direct exposure to oil and gas commodity, exposure, so to speak, and then, be able to, transfer these assets down to your great kids and grandkids. So it's something that's got a unique aspect to it from that standpoint.
It's very interesting. So what does a deal look like, just for context?
So there are lots of different ways to invest in minerals and royalties, and of course, I'm sure as you tell your listeners, this shouldn't be construed as investment advice. So I'm not in that position, but just in general, just to describe this asset class, you can invest through actually publicly traded company that invests in minerals and royalties. So there are several companies out there that's one way to get exposure. Probably the easiest way is to go and do research and find those companies that are primarily royalty trusts or royalty investment companies that go out and buy minerals and royalties, and you would get exposure through owning stock in that company. Um, Going down the rabbit hole a little bit further, there are more complicated ways or more ways to get um, more direct exposure. There are lots of mineral funds out there where you can get exposure through a limited partnership. And so you'd have the general partner out there going and finding and locating these deals, purchasing the properties, having a portfolio of multiple interests across different basins, different states, perhaps different commodity mixes, some gas, some oil, because those commodity prices will go up and down, sometimes not connected with each other. And so that's another way to do it, where you're, sort of trusting that general partner to go out and do the work and invest directly in those, and then you get a preferred return and exposure from that standpoint. And then of course you can go out and do the investing yourself, and there are several auction sites that are out there. Just probably the most well known is EnergyNet. And if you're an accredited investor, you can get an EnergyNet account. You can see what properties are out there. They're online auctions, so you can bid on properties that way. It's more risky because then you're having to do the due diligence yourself and make sure that you're not paying too much for these properties, which is always a risk when you get caught up in that auction fever. And then, kind of the final way is to go out and find mineral owners that are looking to sell their properties and, buy them directly from those people. And then, again, you're having to do all of the work yourself, the due diligence and things like that. There are advisors you can work with, like landmen, which are the people that go and run title to make sure that the person owns what they say they own. You can hire a consultant to run economics and do the discounted cash flow analysis on those future royalty payments to figure out what the purchase price should be. And, all of that, you're kind of in control of that whole process. And then, responsible for managing it in the future. So
what does the tax benefits look like on this in this asset class on edge?
So it depends on the type of interest you're getting into. What I've been describing are on the mineral rights and royalties side of things. It's generally a passive investment. There is a tax deduction that you get to take. It's similar to depreciation with like a rental property or something like that, but it's called the depletion deduction. So you get typically a percent depletion is what people take, which is a 15% off the gross royalties you receive in that year. You get to deduct. So that there's some tax advantages there. The main tax advantages with oil and gas investing get into investing what's called a non-operated working interest, which is basically on the oil and gas lease side of things. So the company that goes and leases it, you can get, if you're the person that goes and leases it, participates in the cost and the expense of drilling that well, and your ongoing expense for operations and maintenance of that well, you have what's called a non-operated working interest. So you're not the one that is operating the well, but you're an investor directly into the drilling of that well. Those have some significant tax advantages in the terms of being able to expense that initial investment in terms of what's called an intangible drilling cost, and those intangible drilling expenses in the year that you get it. So that's got some significant tax advantages, but then there's a lot more risk with that. There's ongoing expenses. If there's maintenance required on the well, you have to pay your share of that. If then when the well stops producing, when they need to go and plug it, you have to pay your proportional share of that as well. So there's some definitely different level of risk associated with those, but there's some additional tax benefits.
It makes sense. It makes sense that the more risk you take, that the more tax benefits you will get. The government does need entrepreneurs to come into asset classes and actually take on risk, and therefore there are incentives for them. So that definitely makes a lot of sense. What I find interesting, the first time I was exposed to this asset class is I live in Pennsylvania, and we have some friends in Pennsylvania, pretty close to New York. So I guess you could call it upstate. um, and there is a ton of land there that people have purchased, and on that land, the mineral rights are extremely, extremely important. And it's interesting, the land that our friend has over there, they own the mineral rights on that. So they collect these mineral rights and royalties monthly, as well as then what they produce on that piece of land. And it was interesting. This is what I always just do. All my mind works. I always look at when I'm in different areas. I look at the real estate. I pull up some property. I look at some land, and then I looked at a lot of places for sale. And what was fascinating was a lot of them didn't come with the mineral rights. So I guess a lot of them, the owners would say, "Oh, well, we're going to keep title or hold on to the mineral rights and royalties, but we'll sell you the land, right?" So it looks like there's a lot of deal structuring and different types of ownership that's involved in this space.
That's exactly right. Yeah, the ways that excuse me. Yeah, the ways that you can own minerals and royalties, it can be in fee simple, where you own both the surface and the mineral rights, like your friend, like you described, or you can have a situation where the mineral rights have been severed from the surface, and then those can be deeded separately. So there's lots of different ways that you can handle that, and it's of course just part of that overall bundle of sticks that you get when investing with real property. The mineral rights are one of those sticks in that bundle. So that's definitely something, especially in the area that you're describing, the Appalachia Basin. The Marcellus Shale is a very well known natural gas play, and so there's a lot of value to the mineral rights if they're drilling nearby and things like that. And so savvy property owners will retain those. Maybe they're selling the farm or selling their house, but they are receiving royalties and they want to keep receiving those royalties. They can reserve the mineral rights when they sell the surface, and then they can enjoy that benefit going forward still. So
Yeah, so that might be that they end up selling. Let's just say hypothetically, they could sell that land and just hold on to the mineral rights and the royalties, and they will keep collecting payments on that, and then they would have sold their property, right? The actual land.
yeah, exactly.
Yeah. So it looks like there's great cash flow advantages here, and there's different ways, like you explained, that people can access that. We like the direct one because that ties into the second piece of our opportunity filter that we use, which is the tax benefits. Obviously, if you have direct investment, then you get to benefit from that instead of just investing through the equity markets in a company that profits in that space. So you've got great cash flow, you've got a great tax benefit. What does the deal look like as far as appreciation of the value of the investment? Does that come into play too through proper management and operations?
Definitely, and it really all kind of starts with kind of, as you would expect, what the purchase price is, right? So um, the the way that you look at these deals is very different between a property that is producing royalty payments right now. Maybe it's been completely drilled out. There's no room for additional oil or gas wells to be drilled. And so you're just receiving that. It's sort of like an annuity. You go ahead and you can pay a lump sum cash, and then in exchange for that, you get those continuing payments into the future. Now, the thing to keep in mind with oil and gas royalties and with production in general is that it's declining. So when these wells are initially drilled, they have very high initial production that will decline fairly rapidly over the first couple of years of the life of those wells, and then it'll sort of stabilize out and be fairly flat going forward. But it kind of depends on where you are in that curve, so to speak, as to the what kind of yield you're expecting from that investment, and again how much you're paying for it. And where I've seen the highest yield, the highest return is when you're going into buying undeveloped minerals that are in a good area. It all depends on the geology. Not all mineral rights are created equal. You can go buy mineral rights in the middle of nowhere that'll have no wells drilled on it, and so in that case, it's not worth very much because there's no future cash flow potential. Versus, in your case, the example again, in the Marcellus Shale, they're drilling lots of natural gas wells. Now, dependent on what natural gas prices are doing, can determine what your future yield will be or what the return will be. But the way that I look at it is if you're buying that initial, right before the initial production, you got in sort of at the ground floor, so to speak, those returns are going to be very high at the very beginning. So that yield, if you're getting in and buying it at a maybe a present value discount rate of 30%, let's say, you could expect that you're going to have a really significant return on that investment. Maybe you'll break even in a couple of years, and then you have that, for the life of those wells. For the rest of that time, you're receiving royalties. So it just really depends very much on the individual property, the underwriting that you do, how much you're paying for it. But, it can be a very lucrative prospect. But then on the flip side of that, you're also not in control. Those wells, you have some, based on the other wells that have been drilled in the area, you might have an idea of what those wells should do. After they drill them, maybe they don't come in as good as you expect. And so then that ends up, with a lower return than you're expecting. So there's some risk from that standpoint, from those things that are out of your control. But yeah, in general, it's really very dependent on, where you are in the life cycle of those wells, and then how much you're paying for that property.
How do you achieve clarity, certainty, and predictability in a world, economy, and markets that are volatile and chaotic? How do you have confidence in an environment where change and disruption is constant? Setting up infinite banking is how you establish certainty in an uncertain world, predictability in an unpredictable world. With an infinite banking policy, you have your capital warehoused outside of the Wall Street casino, where it is guaranteed never to go down in value and guaranteed to grow tax-free. You have guaranteed access to your capital, and you also will be able to access your capital tax-free to use to capitalize on opportunities as you come across them. Creating your own banking system with infinite banking can be your secret weapon to protect and grow wealth during turbulent times. You can watch a presentation and explore infinite banking options for you and your family at yourownbankingsystem.com. That's yourownbankingsystem.com. Now, you had mentioned some of the players already in this space, but can you give a little bit of an overview just of the ecosystem too, of all the players that you find here?
Well, I would say that there are really in the past 10 years, a large number of mineral aggregators. So those are companies that have a team of landmen, which are the professionals, both men and women that are in the land profession, that are the ones that are doing the research in the county courthouse to figure out who owns the mineral rights, and then going out and contacting those people. They're out there aggregating these small interests because as you get into inheriting these properties, they get subdivided. Maybe the original farm was 100% of a quarter section of land. Well, it's gotten passed down through several generations and subdivided to kids and grandkids, and so there are fractions of those, and so they try to piece all of that back together and get a significant enough portfolio. Those players are typically backed by private equity companies, so they have between 50 and several $100 million that they're working with to invest in those targeted areas. There are individual mineral investors. So I have several clients that I've coached and helped to get into this space, and they're just out there doing that work themselves. Sending letters, making phone calls. There's some things like the tax rolls that sometimes you can use to identify who owns the mineral rights. Sometimes things like when someone passes, a personal representative's deed gets recorded, and so you see who inherited those properties. And so there's different ways that those people are kind of picking up those crumbs and trying to figure out, trace the breadcrumbs to figure out who owns what, and then contacting those people and making offers to them. And so there's like on the direct investing side of things. And of course, like I mentioned earlier, there's the publicly traded companies that are, that going that route. And it's similar to the private equity backed companies, just different capital structure. But yeah, there's kind of the bigger players and then sort of everyone in between that are out there in this space.
What are some of the biggest trends currently in this space? Because obviously there's a lot happening politically, and there's a lot of things happening globally with this effort and push to move to a different energy system, if I can call it that. What are you seeing in this space with regards to trends?
Yeah, and that's an interesting area because you hear in the news that net zero by 2050. You hear a lot about solar and wind, and that those are important. I think we're my the mindset that we need all forms of energy. The reality though is the majority of our the primary energy comes from coal and oil and gas. And I did an episode recently on the podcast where we dove into the energy transition and the need for more energy as the population grows, as more developed countries kind of work up that curve to give more people access to electricity, to clean cooking fuels, and things like that. The reality is we're going to need more energy in the future of all forms. The need for oil and gas is projected by the IEA between now and 2050 to remain pretty flat, which means that we would continue to need to drill and invest in new wells, continually between now and then, because like I mentioned earlier, these wells that are being drilled now, these shale wells, these horizontal wells that are, drilled that are, 2 miles long, and they hydraulically fracture the rock to get the oil and gas to flow into the wellbore. Those have a very high initial production rate that declines very rapidly. So the way to maintain production flat, you have to keep drilling and keep investing capital. So, the trend that I see is continued need for oil and gas through our lifetime. We need all forms of energy. So solar and wind are going to be very important. And I think nuclear power is going to also be very important, which isn't seem to getting as much press in that carbon, low carbon future, which is the way to get there, I think is with a lot of nuclear as well. So yeah, I think, it's interesting. You hear, I think there's a dichotomy between what you're hearing in the news around the need for, tomorrow we're going to all be driving electric cars and everything's going to be powered by wind and solar. However, the reality of needing, affordable, reliable energy means that oil and gas need to play a very important role into the future. So.
Doug Casey has said on the show, a legendary investor, that politically created distortions creates enormous opportunity. And there are so many currently right now. And that's why I personally am extremely bullish on oil and gas and mineral rights and royalties and this and well, those spaces, because like you were saying, we can't just shut off the current energy system that the world's running on, because there's no other system yet to transfer to. So that could take years and decades to build that out. So what this happens is there's a massive disconnect between the theory and the wishes of how you want things to be versus the reality. And that distortion right there is going to create an enormous bottleneck, which is going to result in an enormous opportunity for investors that are realizing what's happening and can figure out how to position themselves, right?
Yeah, you're exactly right. I think it really does present an opportunity, from a supply and demand. So you're very dependent with these types of oil and gas investments on commodity prices. So, in after the pandemic, when prices went negative, effectively we had oil and gas prices in the $30 per barrel, and so that was a very difficult time if you were an oil and gas investor. However, in 2022, we had oil over $100 a barrel. It was a great time. So you have to be prepared to ride those waves of up and down. I think that to your point earlier, I think with demand being there and barring some massive global economic downturn, I expect that you'd see continued increased demand for these commodities, and so that would help stabilize prices. And I think with natural gas, we're seeing that in particular. There's a bit of a glut of gas here in the United States right now, with prices hovering around the mid, say, $2.50 per thousand cubic feet of natural gas to maybe $3. We've come up a little bit from where it was a couple months ago, but in um, the grand scheme of things, we see a lot of liquefied natural gas (LNG) export capacity coming online starting in around 2025. So the expectation from the markets, if you look at the futures prices, is it will have a significant increase in commodity prices, in a year or two from now, when that new demand comes online effectively, and so that will help relieve some of the issues we're seeing in the oversupply right now in natural gas here in the U.S. So I know there's some investors that I've spoken with that are really looking at that as an opportunity. To your point, where the fundamentals of the market show that there is going to be a need for this commodity, an increased need in the next couple of years, and so we have slightly depressed prices, which hopefully means you could go in and buy assets a little bit lower valuation, and then look to hopefully that plays out and you profit from that. But there's always the risk, of course, that something could go sideways or pear shape, and that the prices could go down. So that's something you got to be prepared for. But I think there's ways to diversify and help spread that risk, though.
Yeah, so you brought up the risk, and that's a great way to segment into this. How does this go pear shape? How do people lose money, and how does this go? This doing deals in the space. How does this go wrong for investors?
Yeah, I mean, I think one way that it can go pear shaped, you're at the mercy of the oil company to go and drill the wells. So if you're buying minerals that are undeveloped, maybe there are permits for new wells that have been issued that you are, buying the mineral rights underneath those wells that are permitted. Well, something could happen, to that company or to the market, and they don't end up drilling those wells, in now or in the future or ever, and so then you're owning this property that's not producing cash flow that you were expecting that cash flow, and you maybe priced the purchase of that property on that. So that's one way that you can end up in a bad situation. Now, the way that I look at, again, the diversification way to get away from that concentration risk, if you're concentrated all your pennies into one property and that happens, then you're out of luck. But if you're buying multiple properties across maybe different commodity mixes, some oil, some gas, different states, for different regulatory environments, and maybe one of those that happens to one of them, but then another one, maybe you get wells that are drilled sooner than you were expecting. And so those things sort of balance out. So I think it really, there are ways to mitigate that risk that I mentioned. The other thing, like I said, alluded to, is the commodity price exposure. So there you are, have to make some assumptions as to what commodity prices will do in the future when you're underwriting these deals, and you're probably going to be wrong. And hopefully you're wrong on the low side. So in other words, your expectation for what commodity prices are going to do are conservative, and then prices are higher than that, so you get a higher return than you were expecting. But on the other hand, the things could go the other way, and you could have prices that are lower than you're expecting, which would hurt the returns. And again, I think other ways it can go bad is if you're getting into this and you don't know really what you're doing, you don't have that team of advisors that are helping you to do the diligence on these deals. Somebody claims that they own the mineral rights under a piece of property. You give them money, they give you a deed, but then you do title work, and it turns out they didn't own the mineral rights. So you purchased nothing. You did not purchase, the minerals. You got a fraudulent deed. So you have to be very careful if you're going to go the direct investment route, and make sure that you're doing the title work, you're really researching what that person owns, and then there are ways that you can help confirm that are sort of like leveraging the oil and gas companies, which do significant amount of title work. They get title opinions, before they go and drill the wells to make sure they're paying royalties to the correct owners, to make sure all the minerals are leased, so that they're not trespassing on those minerals. And so they have a robust title that you could leverage. And so if somebody's receiving royalties, for example, that can be another way to corroborate what they're saying, that they actually do own royalties, because if they didn't, then the operator probably wouldn't be paying them those payments. So there's and then with oil and gas, there's unfortunately a history of shysters or con men that have looked to prey on unsuspecting investors, both through direct investment in drilling wells. I see a lot of cold calling of to accredited investors, with these amazing looking returns that seem too good to be true. And if they seem too good to be true, they usually are too good to be true. So there's also, you got to be very wary of investing your money with anybody in particular, not just in the oil and gas space, but, that's obviously something that there have been people that have preyed upon those people that are maybe unsophisticated in that space, just because there's so much technical knowledge that's required. If you don't have the right advisors with you on your side, then you can get taken advantage of. So.
No, I appreciate that. Every single investment asset class and niche has undesirable characters that play in it. They just do, and that, I think, that is the one thing that I want to just stress on again for all of our listeners and our viewers. It's not just Wall Street is easy to pick on, but the reality is it's everywhere. It's in every single space. So I'm glad you brought that up, because people have to, especially right now, be cognizant of that. And then it seems like, from a due diligence perspective, it seems like it's very, very important to figure out who owns what, and and those deeds and titles become really, really important to make sure that you actually get what you paid for, or what you thought. What are some other things that those are obviously two things as part of the due diligence, but if you could just give like a high level overview just of some things to take into consideration as far as due diligence, that would be great.
Sure. Yeah. So when I go to do the due diligence for an investment, I look at, first of all, I'm doing a very high level title work to figure out who do I need to contact. And so I'm first of all really identifying those areas where there are new wells permitted. Maybe the operator has started to drill a well already. So there's a clear line of sight to immediate cash flow. So for me, and that's the highest return type of investment. A lot more competition with those, but then also there's a reason for that. It's because it's generally you're de-risking a lot of those things we talked about in terms of the likelihood of it not getting drilled. Well, if they're already spending capital to build the surface facilities and to have a rig on site, there's lots of money that's going into that, and they're not going to just leave that. So that is a good way to identify where to kind of target. And then we look at who are the mineral owners in those drilling and spacing units that are permitted, and it's doing that high level title work. There's the Oil and Gas Commission in some states has a list of interested parties you can go to and figure out who the potential mineral and royalty owners are, and that can give you a starting point to do the research in the county clerk and recorder's office to say, okay, who let's look for those deeds, to your point, and let's make sure that those people are actually owning the mineral rights still, and that this is not just you can't take that list as a at face value. And then once you've identified those people, you're out there talking to them. You're making offers. You're sending letters. Gauging interest. And then once you've identified somebody that's potentially interested, doing the diligence on, what does that discounted cash flow analysis look like? What kind of return am I targeting? And then based on that, what am I willing to offer? And then, having, again, those advisors on your side to, once you're under contract, there's the due diligence period that you have to run full title. So the way that I try to structure it is I'm not outlaying, the expense of hiring a landman to go do that for me until I have a signed purchase and sale agreement, to make sure that that person's committed. And then, if you find that they own more or less, you might adjust the price up or down accordingly. And then you're just going to closing and giving them, funds in exchange for the deed. And then, once that is complete, once you go through closing, you have to notify the oil and gas company that you're the new owner so that they can start paying you royalties. And so that's really important to do that in a timely manner so that you don't miss out on any of those royalty payments. So, yeah, in a nutshell, that's kind of the high level process that if you're going to direct invest in these types of properties that's involved. And there's people that can help along the way. Again, I mentioned landmen, attorneys, and then petroleum engineer or somebody to help you run the economics to help forecast those wells and what the oil and gas production might look like into the future, which can get kind of technical. So.
What does it look like to build out a portfolio of this across different properties in different areas, just from a diversification standpoint?
It really depends on your individual goals. I guess like any investment, it really depends on the investor's financial situation, how this fits into their overall portfolio. Can't give specific advice, but in general, I would say, what I do personally, try to invest in areas that I feel are maybe overlooked. Maybe there's a little more regulatory, pressures on some companies that maybe investors are shying away from because of that perceived risk. And as a result, the economics are sometimes better because there's less competition. You have to pay less per acre for those in that area because there's fewer other investors. Whereas maybe the hottest area in the country right now is the Permian Basin in West Texas, where there are lots of everybody kind of looking at getting in, because the wells are so good. There are so many different stacked formations that those operators are targeting. So there's lots of upside. But on the flip side of that, you're also paying, multiple times in terms of the dollars per acre of some of these other areas. So I think the investment can be spread across those maybe hotter areas to maybe some more overlooked areas. Again, the commodity mix, I like to look at both oil and gas, because if you can get in right now is maybe a good time to be buying gas assets, with gas prices being depressed a little bit, with the expectation that in a couple of years you'll see higher gas prices. So, I think by, again, spreading it out across different states, different oil and gas basins, different commodity mixes, you can help spread some of that risk around.
One of the things that we talk about on the show, obviously, a lot is cash flow. We talk about business, we talk about investing, but we also talk about legacy and leaving a legacy. So I always ask my first-time guests, if you cannot pass on money to future generations, but you can only pass on three principles or values to them to achieve happiness and success and build wealth, what would they be?
Well, I think it's, do what you love, find an area, whether, it's investing or whatever you're doing for your day job, find something that you love, and then, you'll be successful at it because you're going to work hard. It won't feel like work. You'll be, you'll put in more work than, and get better outsized returns than others because you'll just be interested and you'll be active in that area and learning. So to me, that's important. Do something you love, and then kind of along with that, be a lifelong learner. I find that in this space, I've been working in oil and gas for 25 years. I switched from the operation side, the oil and gas company side of things, to the mineral rights and royalty side. It was very different. I had to learn a lot at the beginning about this asset class and about owning minerals and royalties, and about kind of being on the other side of that oil and gas lease. And so there was a lot to learn. And I think that, I continually learn something new every day. There's nuances around the legal structures in different states, tax implications, things like that I'm always learning about. And so to me, that's the biggest, the second thing is to learn. And then, I think the other thing is that if you can invest and be an investor instead of an employee. I think that, for establishing a legacy for you and your family, I think that is the most powerful way to go. Everybody that we look at and we admire that are successful, that have started companies, started businesses that are, in the headlines, that's what they've done, right? They've looked at, how do I invest my time, my money to create something new, to build something for my family. And so I think, if you can become an investor versus an employee, I think that would be the other lesson is there's, and if you're doing something you love, then you'll be successful at it.
Awesome. Matt, where can folks follow you? Where can they stay in touch of all the things you're involved with? You've got a great podcast sharing everything that's going on in the space. And where can they stay informed and up to date of what you get up to next?
Yeah, so the best way is probably through my website, mineralrightspodcast.com. If you want to email me, you can send an email to feedback@mineralrightspodcast.com. That goes directly to me. Happy to share what I've learned in this space. And I have a free resource guide for your listeners if you want to learn more about the different ways to invest in minerals and royalties, how these assets are valued just at a high level. I put a free resource guide together, and that can be found at mineralrightspodcast.com/cashflow. So again, that's mineralrightspodcast.com/cashflow, and you can download that free PDF with some more additional resources there. So
I really appreciate that. I appreciate you making that available. I just also wanted to share, Matt also has a basics course where he goes through his whole due diligence process that folks can access also at cashflowninja.com/mineral rights. So there's a couple of URLs for anyone that's interested to learn more about mineral rights and royalties. This has been fantastic, Matt. Thank you so much for coming on the show and sharing your journey and your knowledge and insights and providing so much value for my listeners and my viewers.
Absolutely. No, thank you again, MC, for having me on. This has been fun.
Awesome. And thank you to all of my listeners and my viewers for again spending your most valuable resource, your time, once again with me. Everything Cashflow Ninja is at cashflowninja.com. All of our podcasts, all of our books, our reports, and much, much more. Everything at Cashflow Ninja. And do not forget to sign up for the best newsletter in the alternative wealth strategy and alternative asset space, the Wealth Dojo, at cashflowninja.com/subscribe. Until next time, live infinitely. This presentation is for educational and informational purposes only. The information being presented and considered does not consider your particular financial objectives or situation, and it does not make personalized recommendations. This material is not intended to replace the advice of a qualified tax and legal advisor or other qualified professionals, and you should not use the information in place of a customized consultation with a licensed professional regarding your specific personal financial objectives, situation, and needs. We believe the information provided is reliable, but we do not guarantee its accuracy, timeliness, or completeness.